let me lay out the problem for the average CNBC investor that contacts me. They've been forced much more into high yield in the last 4 or 5 years, of course. So it wouldn't be unusual for somebody to say, I have 5% of my portfolio in high yield, 10% even. I see even more in some circumstances. And now they're messaging saying, okay, what does everybody think should I do with it now? Now, John's position is, on a risk-adjusted basis, it's probably not worth it to hold so much high yield, say 10%, pick a number, and maybe you should transfer into, he suggests, high dividend-paying stocks. Does that make any sense to you, Isaac, or what are you recommending here instead?
Yeah, I think when we look at those equity markets, and obviously there is outperformance period, especially if you compare, as John did, the past decade, where it was an absolutely roaring bull market for equities. But at this point in time, when you look at high yields, it isn't about decade-long periods. It's about multi-year periods for most investors. And high yields, surprisingly, usually outperform the S&P the first 3 years coming out of a recession. And you can go all the way back to the 1970s to see that average. So there is a definite exposure to high yields as these investors look for bonds as a portion of their portfolio. Problem is, like you just said, the last few years, investors have continued to flock to these assets, desperate for yields, with the 10-year, not from a real yield standpoint, not covering the delta it needed to get past inflation, and high yields did. And there's certain spots within the high yield markets where you still have relatively wide spreads. If you're in energy, transportation, industrials, you have a spread range between about 570 and 628 points. If you're in communications or finance, utilities, you have that 323 to 360 or so, and that's compared to the 340 that the whole high yield market has. So I think being very specific in the areas is important, but investors are still looking for a yield. I would agree with John that investors have driven this price really far down, and it's showing significant risk right now. How much reward can you get for this yield? If rates were to rise, historically, if you saw a 1% increase in rates from here, high yields, convertibles, floating rates, those are really the only three places you can normally hide in the bond markets. But at the same time, we're dealing with a huge yield compression. And so with defaults starting to decrease, you're going to have interest rate sensitivity be a major struggle. And that default is important. I mean, if you're looking at defaults at 6.17, I would agree that they would go down substantially from here over the year as long as we get expansion. But you still have very unattractive underlyings for the yields that are being paid. I mean, look at the Tesla runs as an example. To go from a 9.5 yield to now paying out 2.3, you're talking about high-end investment-grade bond levels there. The same thing happened with Carnival. They went from a 12% yield to a 3.26, and that's with a negative 5.5 on their earnings per share. So people are giving money to this asset class, really hoping it will do something. Last year, it didn't even cover its yield. So there is pent-up opportunity in many of these different areas.
What about that? And let me just throw out to anybody who wants to. I mean, in one area I do see that's kind of risky for people is the sheer supply of debt out there. We keep reporting on secondary debt offerings in not only investment grade but high yield here. And thanks to Steve at iShares for supplying this. Total high yield debt new issuance 2020, $400 billion. Year to date, over $100 billion. Can companies cover all this debt from their cash flow, guys? Anybody want to take a crack at this? This is a concern that investors have.
Yeah, I think that's the big challenge is, it's being met easily with the bidder from the investor wanting to take exposure to this. But we've talked about for a while the zombie company mentality, and this can definitely show up in the high yields. They're getting free access to debt. They're able to roll over debt with these very, very low rates. But will they be able to generate profits that can cover this? And we think that's the challenge over the short term. And that's why high yields have really kind of gone flatlined here for a little while as they're trying to see what's real about the economy. Stocks can jump off into the future very easily. But high yields have a maturity date attached to them. They can't do that.
Yeah, Isaac or anybody, has the underlying fundamentals of these of these companies issuing high yield debt improved at all? I mean, do they have more cash flow, or are we just essentially having these zombie companies created or keep going because the Fed has essentially ring-fenced the inevitable default ratio for these?
Yeah, I mean, I'll say one thing before I pass it to the other guys. I think certain areas like energy, now having oil where it is, and we know that the average price for oil producers to be in the mid-50s to be profitable. So now you're in the 60s. I think that helps recovery rates instantly because with defaults last year, so many companies or other energy companies weren't going to be buying the lease or the equipment of a failing company. Today, they're able to. So there's still companies not able to meet costs, they're going to go under, but others can jump in there. That will push recovery rates up. That will help out the markets. But also, when you're talking about this amount of issuance of debt, you're seeing consolidation within high yields. As these rising stars start to move out, the ones that were fallen angels before start to move out of the junk bond space, you're getting a consolidation of what's available to you in inventory. Now, there's a lot of issuances, but you're getting a smaller group of securities to work from, and a lot of them are showing up in the triple C space that you still have to be nervous about.
Right. So, Steve, what about any other particular sectors of high yield that are vulnerable? I mean, he mentioned energy. I don't know if you want to comment on energy, but what about, I don't know, malls or something like that, real estate?
Yeah, I mean, I think the one interesting thing to point out about high yield over time, and this is actually pretty interesting, is that the overall quality of the universe, notwithstanding what's happened during the pandemic, but if you look over the past 10 odd years post financial crisis, the amount of double Bs has increased from a little over a third in I believe it was around 2007 to over 50% now. Same time, triple Cs have decreased their portion to, I think, the low teens from around 20% pre-crisis. So the overall health of the universe has been improving over time. I think in terms of, interest coverage, that's starting to show improvement. If you look at, where we sort of troughed, it wasn't that far off of previous compression and interest coverage, and it seems like it's starting to improve. So, again, fundamentals, you are going to need a solid handoff between the stimulus measures now and real growth. The energy sector, as was pointed out, is improving. In terms of what sectors are of concern, I mean, I think, from a fundamental standpoint, you wonder about retailers long term, how they're kind of coping through this, and what their cash flow profiles will look like going forward. As an example, I do think it's good news that oil is above 60. It's helping those energy companies. And by the way, Bob, I think you may have pointed this out before. The energy company default rate was approaching 20%. So they were really driving a lot of the overall default rate for high yield. Same thing with recovery. Energy recoveries were quite low, which is dragging down that recovery rate to the low 20s. So it is good news that that profile is improving.
Okay. John, I want to just move on very. Go ahead.
I was going to say on that real estate side, it's a mix too, right? When you look at what's going on with office space, that's going to be a problem for a while. Retail is trying some new, with low rents, they're trying some new store methods and structures. Then you have residential real estate, who's doing extremely well. But with the energy prices moving up, you're now seeing lumber move towards double the price over just the last few months. And that's going to squeeze those home builders. It'll help existing home sales, but it'll be challenging in other spots. So these companies that are in the junk space, really, one piece moving affects a whole bunch of different areas for them to continue to make profitability and cash flow.